And you always want to put yourself in like the highest probability outcome for success. And so we'll talk about some different ways to do that.
That's a stop sign to tell you, don't trade me, because you're in Hotel California where it's really easy to get into a trade, but very hard to get out.
That's 3 scenarios where I win and 1 where I lose. And in 2 of those scenarios, I'm wrong about my thesis. I love trades like that. There's nothing more fun than being wrong and making money.
Welcome to Anatomy of an Options Trade. We are so excited for you all to be here. I know that there are a lot of options traders in this room. A show of hands, who's an options trader here? Good. You came to the right session. We're going to be doing some live trades. We timed the session great. We got an hour before market closes, so we're going to do this fast. I'm Daniella. I'm the product lead of the options team here at Robinhood, and I'm joined by Nick over here. Nick, if you want to give a quick intro.
I'm the director of options here at Robinhood. I'm excited to run the platform today for you guys.
Awesome. Thank you. And of course, we're going to be using Robinhood Legend. I get so excited when I see that fire up, so you're going to see it in just a bit. We're going to have options experts up here, and this is going to be fully interactive. So yes, we say we're going to have Q&A at the end. I want it during. So after we sit down, we're going to get to know the traders, and we're going to pull up Robinhood Legend. That's your cue. You're going to see people walking around with mics. Please interrupt us. Raise your hand. Ask questions about why are they making that trade? Why are they making those decisions? We want to get into the mindset of these options experts and really understand how are they thinking about placing their options trades. Quick disclosure, of course, with options, there is risk. Any content that you see here is for informational purposes only. We've got ODDs in the back. We've got the QR code right here if you want to scan that quickly. But why don't we get into it? I'm going to intro our experts in just a bit. We're going to chat quickly so you can get to know them. And like I said, I want to spend the majority of the time that we're here together making the live trades, asking questions, really understanding what are they looking for? What are the signals when they sit down in front of their machines first thing in the morning or at 3 o'clock in the afternoon? So let's meet our traders. We're going to start with, you've seen him earlier today, Mr. Dan Nathan. So he's the co-founder of Risk Reversal Media, co-host of Fast Money, CNBC's Fast Money. He's got 28 years of financial experience. Welcome, Dan. Next up, we have Stephen Quirk. We know him as Q. He's the chief brokerage officer at Robinhood. He also has decades of experience starting on the SIBO floor, and he's here to also walk us through some options. Come on out, Q. And last up, Michael Obucina. We call him Obi. He's our head of education and manager of options. He hosts our weekly The Week That Was. Please check it out tomorrow. It is a great podcast on Fridays, and I've learned a hell of a lot from him in my own options and futures journey. Welcome, Obi. Well, I know there are a lot of people. I got a chance to talk to a lot of our options customers throughout the past day, which has just been amazing. And a theme that I've heard is just the wide range of people in their own options trading journey. And that's where I want to start. Dan, I'd love to start with you. I know you started as an equity trader when you first started and had to build up that journey. So tell me a little bit about, that first year of options trade.
Sure. So I probably stumbled through options like many of you in the beginning and probably made lots of mistakes that I wish I kind of knew a little bit more of back in the day. I started as a long short equity trader in 1997 as a hedge at a hedge fund. And really the idea was trading a momentum market, really finding the sort of names that were moving in that environment. And you could probably guess what they were. There were internet stocks back then, Amazon, Yahoo, Excite, that sort of stuff. And so we're just trading them directionally a lot. Now, every once in a while, we'd like to get some leverage on those positions, and we'd be buying calls, all the wrong calls, like all the time, and we're like, wait, I got the direction right, but why is my call option not making any money? So I just kept on making mistake after mistake after mistake. Mm-hmm. After 10 years, I actually went to go run a proprietary trading book within a derivatives group at a large investment bank. And then I got schooled in this stuff. They textbooks, they gave, all this sort of stuff. And so for me, that's when it all started coming together a little bit. I was starting to marry my kind of, long, short equity view with how to use these instruments to kind of do three things. And I would say add yield, add leverage, and for risk management. And that's really been my story over the last, call it 15 years. I met Q all the way back then when we started doing it, an options show. And the whole idea at its infancy was really to take equity traders and show them how to use these products and really help their individual stock trading, index trading, whatever the heck it was, and obviously for portfolio management.
Q, I wonder if you could maybe dive into that a little bit more. I know you started on the SIBO floor. Can you tell me about maybe lessons that you learned? It is about kind of failing and learning at first. What are some lessons maybe at the beginning that you can remember?
I hate to date. Oh, is my mic working?
You're good.
Yeah, can you hear me? Yeah. I hate to date myself, but I started the week of the crash in 1987. So it's gotten quieter every week since. That was pretty wild. But I actually started at the CME. And there was options trading happening there, and then moved to the CBOE. So I would say I had 600 mentors.
Oh, wow.
But much like Dan, you just learn as you progress. And having moved into retail, the progression is usually, as Dan kind of laid out, people start trading equities, they dabble in options, and then they sort of work their way up to having a better understanding. Everybody has those lessons. I bought a call. Stock went up 10%. What the hell? I didn't make any money. They call the broker. You guys are ripping me off. No, actually, I think you need to understand how these options work. There's a decay that happens and, all those things which you're all familiar with or learning. So I think, part of it is as much as we can, we like to, I like to use the analogy, the pilots when they fly, over the country, they radio back and tell the people, hey, don't go at this altitude. There's bumps. As much as we can do that for you, that's what we try to do. You don't have to learn this all the way we learned, the school of hard knocks. We can tell you all the things that you're going to need to learn. And so hopefully your journey is much smoother.
That is something I think, we've all benefited from, mentors that we can ask questions to. For the folks out here that maybe they're day trading at home, they don't know how to connect with people. Do you have any, Obi, do you have any advice for maybe how do you build up learning when you're not on the floor?
Anyone just see the session with me and Mark Fisher? Awesome. Well, Mark and I talked a lot about building a trading community, and it can be a lonely place as a retail trader. So meeting other traders, connecting, finding people that trade similar products to you, but then using them as a sounding board. Hey, I've got an idea. Tell me why I'm wrong. Most retail traders don't know how to do that. What we've seen, and especially in the last few years with COVID, social media, Reddit, sort of the social nature of trading, it's become more of a momentum thing. Like, I see that person doing it, so I'm going to follow. Where some of the best traders, I would say, is, why is that person wrong? Am I wrong? They constantly question their thesis. And we heard that from you guys this morning on the tape panel. So I think that's the biggest difference between, I'd say, a newer trader and someone that's been around the block a few times is they have that network. They're willing to admit when they're wrong. And more importantly, they don't, that fear of missing out, it's less and less and less as you become a more seasoned trader.
I want to hear more about thesis building. So Dan, when you're looking at the charts, or where are you starting from? I think a lot of people, they might go into a trade and you're holding onto the desk and hoping, and there's a lot of adrenaline and emotion that goes into it. How do you reduce that emotion, or how do you build your thesis?
Well, I think, trading options is actually one way to think about doing that, to de-stress a little bit, because most of the cases you're defining your risk, and I just want to say one other thing, going, on top of what Obi just said. If you're here right now, that means you're curious. And if you're curious, right, then what you're doing in the markets right now, you want to learn more. There's aspirational products out there. And so one of the things that I just listened to Vlad last night and some of these other sessions, they're really giving you the opportunity to kind of move away from your comfort comfort zone, and they're giving you the tools to learn about it. And when I started doing this, it was really clunky sort of stuff. I'm sure you know the systems that we were using and that sort of thing. And you would make mistakes just fat fingering things, by the way. Okay, so a lot of this stuff is making I think the job for you guys a lot easier. So just back to your question, Danielle. When I think about this, I usually, and it's not too different what we were just talking about at the market call, I'm looking for opportunities. How does an opportunity usually arise? It's usually some sort of catalyst that I can look at. If it's a single stock, it might be a product announcement. It might be an earnings call. Who knows? It might be something competitive, right? Like that's one way to think about it. If I'm trading like an index or a broader market, it might be some economic data. It might be a Fed meeting. I mean, the list goes on and on, right? So I usually like to start with a catalyst, and then I'll kind of evaluate, what do I know best in this area, right? And so if it's a stock, well, maybe it's technology because I'm following this stuff pretty closely and that's where my background is. And so then I'll just kind of zone in on something that I've been involved with and then say, well, maybe there's a really good opportunity here. And then I'll evaluate, okay, do I want to buy, let's just use a single name. And let's just say it's NVIDIA for all intents and purposes. And I'm bullish in it. They have earnings next week. The implied move in the options market is 10%. So that means it could go 10% either direction. But like, you know what? The stock's up 170% this year. Maybe I don't want to take that risk. I just saw ASML go down 20% like that, right? And so I might say, okay, let's look at the options market. Let's see what the implied volatility looks like. That's the price of options. Let's look at some different strategies. Well, I can buy a call, but if it's 10% of the underlying is the implied move, then half of that would be the call premium. Like, do I really want to risk that much, sort of much? Then I might say, well, maybe I'll do a call spread. I'll buy a near the money call and sell an out of the money call. So I'm just stress testing this stuff, and I'm looking, really it's a risk reward thing. And then I don't want to do what Q just mentioned. I don't want to be in a situation where I get the direction right, but I have the trade structure wrong, right? And so we're going to go through some trade ideas here and how we think about it, and we'll kind of give you a sense of like how to evaluate these different strategies. And you always want to put yourself in like the highest probability outcome for success. And so we'll talk about some different ways to do that.
I think you described that perfectly, and we are going to get a chance to go step by step. And please, like I said, interrupt us if you have questions about what are they looking at, how are they making decisions. You touched on something too about the right strategy. I was talking to some customers last night, and Q, I have a question for you to help me answer this. I asked them, do you ever do multi-leg strategies? And their answer was no, because I don't want to cap my gains. How would you answer that?
You're capping your losses. So first of all, to sort of build on what Dan was saying, like situationally, I learned to trade very differently than most of you, probably all of you learned to trade. So I started with, I had to take the other side of your trade. I didn't have a choice. That was my job. I take the other side of your trade. So what do? You just heard it from Mark Fisher. If you're in that session, the first thing I do is understand what's my max loss on that trade. And then it's like a sitcom. It always starts with the problem. You work your way up to the happy ending, right? Hopefully. But it forces you to, if you understand your max loss the minute you make a trade, you're not going to get emotional when it suddenly goes against you. You already understand it. You've accepted it. You're comfortable with it. Once you start to think about trades in that manner, of course you want to look at what you can make, but you also got to look at what you can lose, because they're not all going to work for you. And, when you're in the world of trading and you do it for a living, it sounds really weird, but if I'm successful 52% of the time, I'm winning. You have to be able to forget that 48 pretty quick. You got to be like an NFL cornerback. You get burned, next play. I got to move on to the next play. I can't sit there and dwell on that. The people who came on trading floors that had a myopic focus on their losing trade were on that trading floor not very long, because you can't. You got to move on and you got to progress. And that's why we'll get into it a little bit later, but that's why when you start doing multi-leg strategies, you're actually capping your losses. You're capping your gains, but in the long run, I think, when you start to understand the probabilities, you're probably going to be in a better scenario for it.
I think that makes a lot of sense. And we are going to watch that, so we'll see it later on. And that 3 out of 4 scenarios to have success and consistency, I think that's what all of our options traders really want. And you made a sports analogy, and I know Obi is the king of analogies. And I want to hear, there was one around taking the small punches so you don't get knocked out. Can you tell a little bit about that?
Yeah, I mean, I stole this from Mark Basically, it's in his book. But as a trader, you're not going to be right. I mean, Q just said if you're right 52% of the time, that's a positive edge, right? And so the key is that the 48% you're losing, those aren't knockout punches. Anyone remember Mike Tyson? I'm dating myself. Mike Tyson was the king of knockout punches, just boom, boom, uppercut, guy was out cold. As a trader, you're going to have losing trades. And so when it comes to going from a, single long call, single long put, like even though that's risk defined, what we tend to see is that sometimes someone trades too large. I think that's one of the biggest mistakes newer retail traders do is they like, all right, if I get this right, I'm going to make a bajillion dollars. But when you start going from one contract to 10 to 50 to 100, and you have those trades where you're wrong, that's a knockout punch. That could be a huge reduction in your trading capital, where I think the best traders, the ones that have been around for a while, they understand it's a game of preserving your capital, not just what you're going to make, but what you don't lose. And so when it comes to learning how to go from a single option trade to a spread, one, you're putting probabilities in your favor. If you're learning how to sell spreads, if you're buying spreads, you're reducing the cost of trade and reducing your break-even price. So a lot of it is like, hey, I'm willing to forego that home run trade, knowing that I'm going to hit a bunch of singles and doubles, and rest in peace, become a Pete Rose, where I'm 4,000 hits in his career.
Yeah, and to me, like that's the most important thing. What Obi just laid out, there's a couple mistakes that folks make. They average down in an option when it's going against them. That's like the worst thing you can do, because it's kind of what Mike was just saying. It's like, okay, let's say you paid $1 for a call option, right? And it's worth 50 cents and the stock's just sitting there and it's not doing anything. And you're like, you know what? I paid $1. Let me buy a bunch. Let me average down on that thing. Well, your probability of success just went lower, and you're risking more premium at that point. And so I use a mental stop of about 50% of the premium that I paid. And if I do that, if I cut my losses at that point, because most options, when they go below that of what you paid, they're likely to expire worthless, because time's working against you. The price is probably working against you at that point. So use some and I know in some of these systems, that you're gonna be able to use stops, but a lot of mental stops are really important too. And you can kind of set some, parameters on that sort of thing, but you really just have to think about like any trade that you guys have heard here over the last 24 hours. Like when you go into the trade, you have a plan for it to be successful, and you probably have a target in where you want it to go and where you're willing to take a profit, but you also have to do the same thing to the downside.
I think one of the things that the best traders I've ever known, there's one thing, if you said, what's one quality that they have, they're consistent. What do I mean by that? If I consistently am taking a loss at 25% or a gain at X percent, I stick to that consistently, because you know what we all do, right? You get in the middle of that trade. Well, this time it's going to be different. It's not. It's just not. And so if you're consistent, if you come up with a strategy and it works, then you have to consistently apply it to your trading, because as soon as you deviate from that, you're going to deviate at the wrong time. You're going to say, oh, I'm going to take a gain now because I don't think it's going to have a 20% gain. And, you'll take 5% gain and it'll go to 20. I'm not going to take the 20% loss because this time I think it's going to bounce. It's going down 50. I don't, you know how this works, right?
Can I translate that into one line?
Yeah.
Hope is not a trading strategy.
So I heard trade your plan, plan your trade. Consistency, hope is not a trading strategy. I feel like we've talked about it conceptually. These guys want to see live trades. Should we pull up Robinhood Legend? I think let's pull it up.
We got to get Nick working over there.
Yes.
Yeah.
We got to get him going. All right. Oh, gosh. I love to see it. I'm leaving this up to you. I don't know what we want to trade today, so you tell me. Dan, tell me, what should we pull up?
Is that Apple right there?
This is Apple right here.
So this is kind of fascinating. I mean, you guys can see what happened here. This stock was really range bound until about June. I mean, to see a stock like Apple that was a $3 trillion market cap company, right, go up 10% in a straight line in 2 trading days. Remember what happened? It was Worldwide Developers Conference. The company introduced this thing that actually still hasn't been shipped, by the way, Apple Intelligence. Okay, I just want to be really clear on that. But investors and big money investors said this is going to be the next thing, right? So look at that. And then it kept on going. Now, like most stocks in the market, it had that early August swoon, came right back. I mean, think about that. It lost from the highs. It was probably $3.5 trillion in market cap. It went down like 15% or something like that. Just think about the numbers there, right? Now it's hanging out here. It's waiting for something. Well, what is it waiting for? It's waiting for to see if that super cycle and iPhone, sales are going to happen. And then October 28th, they're actually going to ship this product that's going to be downloadable. All right, sorry. That's the fundamental stuff. That's kind of the technicals of what I'm looking at. So then I have to decide. We just saw, maybe Nick, you could pull up Taiwan Semi for a second, TSM. Look what just happened in this stock, right? This looks not too different. It had this volatile period, and it just broke out. Look at that. It's up like 12% on that. So the question you have to ask yourself is Apple setting up for a breakout, and what would be the reasons for it? That's the fundamental stuff. Or are they going to disappoint and have a massive double top and work its way back towards those things? So you evaluate that. Let's say you want to be long. Let's say you think that they're going to have blowout iPhone numbers and this thing is going to be a game changer, Apple Intelligence. Well, then you might say, okay, I can buy the stock here, but maybe I just want to define my risk. I could buy a call, but I'm more likely in Q's camp that I want to actually define my risk to a point where I actually want to define my losses, is the way you thought about it, right? Yeah. So, Nick, what's the at the money strike right there in the call at that kind of upper bound here? What are we looking at?
What expiration do we want to look at, Dan?
Well, let's look at November, okay? Because they're going to report earnings probably the last week of October. Let's call it the 29th, 30th or something like that. Maybe it's Nove 1 or so.
Nove 22 monthlies or?
Let's do the Nove regulars, which is 22. Okay, so here it is. This is pretty.
By the way, can I make a quick point? Because you just brought it up.
Yeah.
He said regulars. Do you know what that means?
We're dating ourselves?
No.
Dailies
This is a good thing.
Yeah.
This is a good thing because you want to find the ones that have the most liquidity, the most volume, the most open interest. Because you know why? You're going to get a tighter spread, right? So it's important. Like you have to be cognizant of what you're trading and make sure that you're getting in the most liquid instruments because you don't want to get into a Hotel California, right? Where you can check in but you can't check out. You know what I mean? So So he said regular. He chose those. You chose them for a reason.
Yes, I did.
Yeah.
Because I'm old.
The regulars being the third Friday of the month. So a little history lesson. Options used to only be every third Friday of the month. It was the busiest day at the firm. You couldn't take a day off. Couldn't get vacation. We had beer and wine afterwards once expiration hit. Now it's a totally different world.
The kids knew we were never vacationing the third Friday of the month. That just wasn't happening.
No, I promised these folks a live trade.
We're going to do it.
We've got the chain up.
Right,
Let's hear it.
So we have Apple. It's trading at 232.
Yeah.
Oh, it looks like we might have a question.
Whoa.
And we got TSM chain. We got TSM.
I go Apple.
That's why I could. Thank you.
See, almost had an out trade. This is why you need a community of traders.
All right.
All
right, community, let's do it. 232 is where the stock's trading. I'm looking at this right here. The all-time high was about 238 or so, all right? So let's just say we're using TSM, and there's a whole host of other examples in the market of late where these stocks, they've been consolidating. They're right back towards their prior highs. You have a fundamental thesis, right? You have a catalyst, a date. So we said that we're going to focus on earnings, and you've come to the conclusion that you think Apple is going to beat, and the stock's going to break out, and it's been a bit of a laggard relative to some of these other mega cap tech stocks. All right. So what I might do is this. I'm looking at the November regulars. It's going to incorporate that earnings event. Nick, what is the 235 call in November trading at right now? Again, the stock's at 232.
It is at 540.
540. So what is that? I can do some quick math. That's about 2%, right? And it's also $3 out of the money, right? So I'm going to say, all right, that's a pretty good level here. If I get there, my break even is at the prior high. Then I might say to myself, how much would the stock really go up, right? If it did have a big move. I mean, again, we just talked about back in June, in 2 days, the stock went up 10%. That's a pretty unusual sort of circumstance. So I might say 235 is where I want to get in this trade. Now, obviously there's premium there and I have to, break even above that. But let's say I think that 250 might be a good target. And some of you guys probably use measured moves and that sort of stuff. Okay. So Nick, what is the 250 in November cost?
What
is it?
$1.09.
Okay.
Go 7 bid.
Right. And so you may say, do I want to sell a $1 call option to limit my upside against a 235. Let's look what that call spread looks like, Nick, right there on the screen, if you guys can see that. So buying a November 235, selling a November 250. What's that cost right there?
$4.32.
Okay, so then let's just call it $4 for, just to run. So if I'm buying a 35, I take the $4 premium, my break even is at 239, and then I can make up to $11 if the stock went to 250. Now, does that sound like a great risk reward to you? It breaks even up at 239, up $7, and you can make up to 11. So this is how I'm like kind of evaluating these sorts of trades. Now, some folks like to leg into spreads. They like to buy the at the money or near the money. And if the stock starts going in their direction, it gives you the opportunity to sell that option higher, that call at a higher price. So to me, this 235, 250 seems okay. What do you guys think? So risking 4, break even up 7 to make 11 if the stock's up $18 between now and November expiration with a catalyst.
I mean, if you look at the numbers, so here's a quick way to sort of establish your risk reward from a probability stance with spreads. So the spread we're looking at is the 235, 250. That's $15 wide. We're paying about $4. So it's basically a little bit more or less than we're risking 1 to make 3. Is that about right?
Ish.
Yeah, it's late in the day and I'm pretty tired. So from a probability standpoint, we know that selling that $1 call for the 250 strike, that's reducing the premium we pay. We still have some decent upside to this trade. And to Dan's point, if we don't think it's going to go beyond 250, this is a nice way to sort of finance the purchase of that more expensive at the money call. So
yeah, and then there's one other thing. I mean, like when I think about these, you can go further out of the money. Okay, you can go to the 240 strike. Nick, what's that trading at? But all of a sudden now, you're $8 away. I'll bet you that call's about, I don't know, $2 or something like that. Does that make sense?
buy the 240. Buy the 240.
I'll buy the 240 with the 250 still. Here we go.
What's the 240 at, Nick?
335.
All right. I mean, that's juicy. So maybe you do the 240, 260. Let's look at that call spread. Okay. So you're buying one of the 240s, you're selling one of the 260s. If you do the math, 32 less 260, you're talking about like 11% move, right? To that higher bound there. Maybe that makes more sense. Look at the way some of these stocks are moving. So what's the 240, 260, Nick? What's that 20 wide cost?
305.
Okay, that's like kind of a big risk reward, especially if you're super bullish. I mean, how do you guys think about that trade? Is that too far out of the money? Because stock's trading 232. If you take the 240 strike, $3 in premium, 243 is your break even.
What do you guys think? Yeah.
We got a mic for you.
100. You're gonna get
Great
there.
question. Great
So
question.
so Q just mentioned the decay, right? So that's data, and you're going to be able to look on there and you're going to see how much that option that you're along is going to decay on a daily basis. Okay, so that's something you would factor into. Now that will obviously move depending upon where the stock goes and how quickly it goes. The other one that I look at, and you just heard Obi talk about probabilities. If you look at the delta, okay, so these are the two most frequent Greeks you guys look at.
Okay. Always on my chain.
So delta is the probability of essentially like when this thing, if it goes in the money, it's basically telling you that, right? So an at the money call is likely to have a 50-50 chance of being in the money on its expiration. So if you look out and you look at out of the money and you're looking at a call that costs you, it's like a 30 delta, it's basically saying there's a 30% probability that it's going to be in the money on expiration. And you have to start deciding what are the inputs that are getting you into this trade, and is that the sort of probability that you are willing to kind of take on? Does that make some sense, Obi? What you guys think of it?
One of the So you're asking about the ratio on the order ticket. Yeah, so notice as Nick's clicking through this, every time he clicks a buy on the ask price and a sell on the bid price, it's queuing it up. So if you wanted to build something like, if you're an advanced trader, like a butterfly, you would hit the ratio and then you would change, like, so if we wanted to do a 1x2 or, this is a much more complex trade. We're not going to get into it, but that just allows you to create something that's like an unbalanced trade, where this is a standard long call spread. You want to do a butterfly, an unbalanced butterfly, a ratio spread. That's how you would do that.
I see another hand raised over here.
So the question was, why would you bother limiting our upside for just reducing our cost by 28 cents?
You wouldn't do that. But what's the 260
Good
called?
question.
Yeah.
Yeah, the 260 calls trading 28 cents.
Yeah. Not a.
Yeah.
So one thing I want to point out, and we do this a lot, the best options traders tweak. So what we've done, we've gone through multiple trades and looked at risk reward. I've told this to you, Daniela. To me, an options trader is not about being like a fast food cook where you're trying to get in, get out, get in, get out. There's maybe products better suited for that type of trading, like futures, for example. But with an option, I think the way we learn how to trade, it's more like baking. It's like getting all the ingredients right, making sure it's set, putting it in the oven at the right temperature and time, and hopefully when you pull out, you got a nice dish. This is sort of that process for a lot of traders. It's just tweaking and finding the right trade that fits our risk reward and the probabilities we're looking to set up.
I've got another one for you, and this is from Ben Constantine, I
I
think.
think he's got a question.
Oh, yeah. Go ahead.
So to his point though, the shorter date. Let's just say you bought that November 240 call. No, yeah. So let's say you bought that a month out. Whatever you're going to sell shorter dated at the same strike to create a calendar. So you're buying a longer dated, you're selling a shorter dated. It's a great strategy. I love calendars. You guys probably love calendars, and especially if you're trading around an event. But to your point, and sir, I'm sorry, I couldn't see what that 260 was trading at. That's not something I would have sold to cap my upside. I don't have my glasses on here, people. No, but like,
You can also turn around there.
I know, but
big
I
board.
got a bad neck too. I'm old here. You know what I mean? I got bad neck. I got bad eyes. Break. So those, Steve, do you have any rules about what an option that you are willing to sell? Like in general, there are certain rules of thumb as like you never want to sell. They call them selling teeny options, right? And
I don't pick up nickels in front of. I do not like you. It works until it doesn't, and then you get flattened. So it's not. I just don't find it worthwhile. I mean, it works 99% of the time, but the 1% of the time it doesn't. You don't want to be in that.
Here's a good example too. If you are running a big derivatives book, which on an institutional basis, which I know you did, you will constantly scan if you're a market maker for options trading at really like single digit deltas that you might be short because you're always going to cover them. You're always going to cover them, even if they're pennies. You know what I mean? Because what happens? Let's say they're puts and you're short and they're 5 cents or something like that. Well, you get some event that comes out, the stock gap's down 20%. All of a sudden, you were waiting to take in those 5 cents or something like that, and you just get blown out. So that's a great rule of thumb. It could be on either direction you're thinking about it.
So let's because this is this what we're doing here is a thought exercise. Like we're not here to give you a specific trade. It's to provoke thought, right? Let's approach this a little different way. We have an assumption that we're going to have a breakout here. Let's take a look at let's take a look at selling the 2/4 230 put spread. Looks like it's about $1.70 and it's a $5 wide spread.
So selling the 225Q.
230. Yeah. So I'm let's say I sell that put spread instead. I'm selling the 230,
On the 230.
225.
And 225.
About $1.70, right? About $1.70. It's a $5 wide spread. So I'm risking 2 to get 1, right? Here's what I want to walk you through, and this is kind of what Daniella alluded to it a little earlier. Let's go through a couple scenarios. There's 4 scenarios that can happen with this trade. I put this trade on because I'm convinced that it's likely to break out. What are the 4 scenarios? It breaks out. I keep $1.70. Right? I'm wrong. It doesn't break out. It sits there. I make $1.70. I'm wrong. It goes down slightly, but it doesn't go down below 230. I'm wrong. I make $1.70. The thing craps the bed. I lose $3.70. That's 3 scenarios where I win and 1 where I lose. And in 2 of those scenarios, I'm wrong about my thesis. I love trades like that. There's nothing more fun than being wrong and making money. So the flip side of that is I think it's going to break out and I bought a call. I bought a 240 call or a 245 call. I was right. It trudges higher and gets up to 246. Woohoo! I was right? What happens? I lost money. I lost money on that trade, right? So am I giving up upside? Absolutely. But it's more predictable. It's a more predictable outcome. You probably heard this stat. Journalists love to throw it at people who, trade options. 80% of options expire worthless. Yeah, if you buy them, but if you sell them, that's a good thing, right? You know what I mean? The first thing Dan already mentioned it. First thing I'm looking at is the delta. It's telling you the probability.
100%.
Yeah,
Delta.
it's just telling you the probability. If I could tell you the probability of you walking outside and getting hit by a bus right now was high, you wouldn't walk outside. So like if I could tell you the probability of you making money on a trade and it's extremely low, I don't know if you'd make it, right? So
Some might want to add here too. I learned this a lot. So I was very fortunate in my career. I never was a professional trader, but when I started, I actually worked at the same firm as Q, and most of the people that we worked with were former floor traders, and they beat into our heads that selling options tended to be a higher probability trade. But when you look at stuff like volume and open interest, there's some clues in there, but you don't know why people have positions on. You might have a trade that someone put on and then a market maker's hedging out here. It's really, really hard to look at those numbers and get a sense of what someone's intentions are. What really volume and open interest helps you decide is the liquidity. Apple, we're never really worried about liquidity on an Apple options chain. Some kind of random underlying where you've got it's a penny stock and the options are this wide and there's no volume or open interest. That's a stop sign to tell you, don't trade me, because you're in Hotel California where it's really easy to get into a trade, but very hard to get out. So that I would say is volume and open interest for me. It's an indicator of liquidity. But in terms of looking at the chain, my first thing I'm looking at, as these guys said, is delta. So if you're looking to buy, if you think this is a breakout and you're like, I want to buy one of these calls, I can scan delta and be 44%, 32%, 21, 13, 8. So you think like, oh, I'm going to buy this cheap 15-cent option at the 265 call. That's a two delta. That's a 2% chance that it's going to be in the money by November 22nd.
And that's not to say that look, people who trade options, continually do that. They just don't, that's not the entirety of their strategy, because it's not, in the long run, it's just not sustainable.
Yeah, I would just say that open interest changes can be interesting, to Obi's point, but they're generally not usually, because you don't know what's trading against it. You can look at things in the options market. You can look at somebody sells this call strike in November and they roll it and they're buying, they call it up and out. Let's say they're buying, a higher strike call in a different expiry. And you said that's a continuation of a bullish call. If you can kind of get it right, you can see that the sale was closing and the buy was opening, that might be instructive. But again, you don't know what it's against. And there's services out there, they're always yelling about buying the smart money, following what they're doing. That's a bunch of crap. I mean, seriously, because again, you have no idea what somebody's doing. It could be a hedge, you know what I mean? Like, you just don't know. And stay away from that stuff.
Yep.
I love that question. I think Obi had mentioned a few weeks ago, when he pulls up a chart, it lights up for him. And I think he sees certain signals and he's looking at these data points. And you asked about open interest. We talked about delta, but we've also been talking about earnings and earnings plays. So IV, we haven't talked too much about. And Obi, I'm curious, how might you leverage implied volatility?
So the first thing I teach a new options trader, especially ones that are simply buying calls or buying puts as directional plays. When you trade stock, you buy it and goes up, you make money. Short it, it goes down, you make money. That's not the case with options. With options, you have to be right on three things. You have to be right, if you buy an option, you have to be right on direction, timing, and volatility, which is the magnitude of the move. And I know, Dan, maybe we can bring up Netflix real quick. This is a stock that has earnings today in 20 minutes, so maybe we can sneak a trade on as an earnings play. So when we think about volatility, this is how much movement the market has priced into the stock. And I know we hate using gambling analogies, but a football game. How many people have ever bet a football game? All right.
Can we admit that?
I'm a Bears fan. Q's a Packers fan. Bears are good this year, finally.
For the Packers.
Yeah. So when you bet a football game,
Kings.
it's not just
Better.
It's not just about, do I think the Bears are the winner or the Packers are the winner? There's a spread, right? So if the Bears are 7-point favorites at home against Green Bay, if the Bears win by 6, I lose. If the Bears win by 5, I lose. If the Bears win by 7, I scratch. If the Bears win by more than 7, I win. It's the same concept you have to have with options going into an event like earnings. So Dan,
Yeah, let's break this down. So this is going to happen 4:30. The press release is going to come out. Netflix has been a monster stock, as you guys have probably been tracking a little bit. One of the first things that I do is I'll look and say, what is the implied movement? What are market makers willing to sell options at, right, to justify what they think it might move? So let's just look at an at-the-money straddle in the weekly. In this case, it might be the whatever it is, like the stock. The reporting is tonight.
the 690.
Yeah, 690. And I'm just going to tell you what it is. So the stock's trading around 690. You're looking at the at-the-money call, the at-the-money put. You put it together. That is the implied movement, because by the close tomorrow, okay, if you get to that implied movement, so let's just say it's $50. Is that right, Nick? Okay, stock's at 690. Okay, to the upside, if you bought that straddle, you would need a move above 740 to make money to the upside. That's the strike plus the straddle price. Bang, up to the upside. Downside, 690 less that $50, okay, that's 640. So you'd need a move to the downside below 640 to make money if you bought that straddle. That's the implied movement. I'll often go back and see how much has the stock moved on average over the last 4 or 8 quarters. You can also figure out how much was the implied movement. Does it outperform that generally over time? And where does this quarter sit? Where does the implied movement sit right now? This isn't really, I mean, to me, this is one of the most kind of important things when I'm evaluating an earnings trade. And I'll just say one last thing about earnings trades. They're really hard. They can be really binary. So let's just say you spent $25 on this 690 call because you think the stock's going higher. I'm not going to repeat all the ways in which you can lose money, but if its stock is at 690 on tomorrow's close, you lose $25, right? Like, think about that. And so if the stock's at 700, you got the direction right, you lose $15. You know, I mean, like, there's a lot of different ways to lose it. I often like to kind of wait and see what the company said, what the guidance was. And if you feel like that the market is kind of getting it wrong and you still have your thesis, that's when I may start to play when the implied volatility comes down a little bit. And let's be frank, okay, what's happened in Taiwan Semi today, this is not, like the norm, right? We can agree with that. Like, like, I'm sure there's a lot of people who just got rich buying out of the money calls and they made a lot of money in 24 hours, but that is not the norm.
Yeah, let's bring up a chart of Netflix. Let's start picking some trades. We got 17 minutes to get a trade on. We promised these folks a trade.
By the way, I'm really curious. If as Dan just laid out, if you needed a $50 move in Netflix, and would you rather sell that straddle or buy it?
Sure. A little louder, a little more conviction.
All right, but let me ask you this. So if you're selling it out of the money call and you're selling it out of the money put, how would you feel if they missed, guided lower, okay, and the stock's trading at, like well below those strikes? I mean, these are the things you often have to evaluate. Guy Dami, who was, with me earlier today, he says this all the time. I mean, a lot of people, they put limit orders in way below the market. And if the stock starts going way below the market for some fundamental reason, you're like, you heard the big short guys talking about, like, always categorizing your trade or, relitigating your trade. I think that's what Vinny said or whatever. That's sometimes why earnings trades are really difficult, and so like those, it really comes down to like a risk reward sort of thing. And I think oftentimes, and you want to do this on the Netflix, Obi, like, so let's say you're long Netflix, okay, and you think the stock, $50 move in either direction, 7.5%. You think that's a lot, but you're not selling your Netflix, but you saw the implied volatility goes up a lot into the event. You might look to sell a call against your long stock position. So what strike would you want to pick, Obi, versus the stock at 690? The implied move is $50 in either direction.
So we're assuming we own the stock as well.
Yep.
He wants to buy. So hang on. It's like
Insurance is expensive. You're buying insurance in the middle of a storm.
Yep. So
you're waiting till earnings. That's like buying insurance. It's.
So this is where I go to the delta and ask myself, okay, how far can I go out of the money and still collect a decent premium? This is the nice thing about earnings trades, is that volatility juices basically the entire option chain. So looking at this, we could go all the way out to, I'd say, if we got more strikes to show, Nick.
Yep.
Another way to adjust your Robinhood Legend. Let's go out to maybe 40 or 50 strikes. And let's try to find something around a 30 delta. So a 30 delta, that's usually like my focal point to start, Dan, if I'm going to sell something against a stock position or a long call. And here I'm still getting $11.65. Now, if a 30 delta means that the probability of this option being in the money by the end of the week is 30%, what's the probability that it's out of the money? 70. Thank you. So we can do our math today. Excellent. So I have a 70% chance of keeping the premium on this option. And even if the stock rallies all the way to 725, I get a twofer. My stock goes up, my option goes out worth it. It's essentially, the basics of a covered call. But going back to our original trade on Apple, if we bought the at the money strike on Netflix and sold this call, we've done that at a much cheaper price than buying a stock that's trading at what's Netflix at 690. I don't have $69,000 in my account to buy 100 shares of Netflix, but I can buy that at the money call for $2,400, and I could sell the 725, and I've created this really nice long call spread.
What's the dream scenario? In like you own this stock, and you decide, you know what, I'm going to take advantage of the premium here. So I sold that 725 call it. Let's call it $12. What's my dream scenario? I go to 724.99, right? That's my dream scenario. But let's not treat it as if we're taking a picture of something we did and we can't do anything with it. What happens when earnings come out and they're kind of mixed? It's a mixed bag. They can't figure out, it rallies a little bit, can't figure out if it's good or bad. You've sold, maybe you had a couple hundred shares, you sold a couple calls. What's happening in those calls as that earnings comes out? They're melting like popsicles in July. The premium's going to get sucked out of those calls pretty quickly. So, hey, you know what? Maybe I take one or two off because I'm getting a little nervous about it popping over the top, and I don't want to give up my upside. But maybe I keep a couple on and see if I can take that whole premium. It's a dream scenario.
Taking a picture is a really interesting way to think about it, because let's just say I've had this happen. You probably all had this happen. You're long the stock, you want it to go higher, you sell a call that's out of the money because you think that I want to take a little premium. I think that's probably where it could go to. But let's say it's above that level and you're getting into the last couple hours of the trading day, you know what I mean? And you're like, I really still want to stay long Netflix, right? Just cover them, like you cover them, you don't get called away, and you're moving your feet. And again, it wasn't a disaster of a trade if it's trading at like 627. And the last thing I'll just say about the covered call, a lot of people say it's like the gateway drug to trading options. You're long a stock, you know what I mean? You're looking for different ways to add yield to it. If you do this, and Q just said this, if you do this consistently with these stocks that are in your portfolio that you're never going to sell, and you look for a certain rule, like Obi just said, it's about timing, it's about out of the money, and it's about probabilities, you will be adding a lot of yield to your individual names and thus your portfolio on a consistent basis.
Can I give you a dream scenario that existed, and I'm going to date myself again. I think it was 2007-8. GA got smoked. Like everything, it got smoked. I think it went down, I'm going to probably get my price wrong, but to like 574 or something like that. But the premiums were through the roof. And you could write a put at the 5 strike for like close to $1. So I write a put, if it rallies back, I keep $1. If it doesn't, then I end up owning the stock. And then I'd go write a call, a $6 call for $1. But you write a put 4 times, you own the stock for free. There's a really good sustainable strategy, and you can't do it on these high notional stocks. It doesn't work. You don't want to put up that much capital, but on a lower value, that's a high premium stock, I can go write a put and say, I'll buy this stock 10% below where it's trading today. And if I don't, I'll just take the premium. Do that. Guess what? As soon as you get hit on it, write a call. But in the course of a year, you own the stock for free. It's free. Then you just keep writing calls. And then if it gets taken away, start over, write a put. So the same thing methodically.
I have a question for the audience. I want to get to this trade. How many people have traded call spreads before, or put spreads? How many people have traded iron condors? Do you think iron condors are that much harder than vertical spreads? Why? It's the same thing.
There you go.
So as you get into spreads, if you learn how to do a vertical spread, or on Robinhood we call it call debit spreads, call credit spreads, put credit spreads, etc. An iron condor is just 2 of those. So what do you say? What do you say? I think we got a pretty advanced career. You guys want to maybe sell an iron condor into earnings?
Can I expand on that for a second? Because I think it's one of the things that helps people lose the intimidation about option trade. Everybody thinks, oh my God, this is complex, Greeks and this and that. And, I'm like, trading options is like eating at Taco Bell. There's like 7 ingredients, right? There's like 7 ingredients.
They're all delicious.
Everything they make just is a different combination of those ingredients. And by the way, I like a lot of their stuff. Oh my God, that's great.
Easy gordita crunch.
Yeah, and that's probably 5 ingredients, right? So like if you know how, you just nailed it. It's 2 vertical spreads. You know what a vertical spread is. It's pretty simple strategy, right? I just put 2 of them together. I do one down here and I do one up here. So, right? Or a covered call. Like, all these things are pretty basic. It's just a combination of those once you get a little more complex.
So let's put this all together. We learned the implied move from Dan. So the implied move was about $50. We learned a little bit about picking options. Let's sell an iron condor based on the implied move. And what we want to have happen is the stock today do nothing. We want it to stay between our short strikes. So let's build. You guys like building the put side first, call side? Let's look at the chart real quick. We got a stock that seems to be sort of reaching a.
I say we should let the audience help us.
Yeah.
You look at the deltas and you help us build it.
So we got a $50
down. Yeah,
right.
Let's do it.
Go back to the option. We got a $50 implied move. So Dan, what was those numbers again?
It was at the 690. Oh, 7.5% in either direction. And so we were looking at the 640 and the 740.
So if I'm building an iron condor based on those, that's maybe my starting post, right? Because we're looking at $50 up or down. So that would be selling those strikes as our short strikes, and then we figure out where we define our risk. So where's that trading at, Nick? 640, we're getting 670. And what do you guys want to just do this for like $5 wide?
Do a $5 one.
So then we'll buy the 630. Now we got to go to the call side of the chain. We're selling what? That's 740. And buying the 745. Oh, sorry. Oh, we got a little 2.5 strike.
Yeah, they snuck.
Well, that's a 5. We're 5. Yeah, we're good. Right, we got the 40, 35, 40, 40, 45. So we've got a 5-point wide iron condor. Our short strikes are based on the implied move. And we're thinking that our thesis here is that Netflix will stay within that implied move after earnings today.
Hey, I got a bonus for you. This is a little trick question. What are we risking here? How much? Let's round. It's $2, right? Well, no.
Is it 10,000?
What I'm risking? How much can I lose? In like if I'm getting $2 and it's $5 wide, $3. No, wait. I'm risking 5 here and 5 here, right?
But it's got to pick a direction.
Hey, right? It can only go one direction or the other. So I'm only risking $3, right? So that's why this gets back to this whole scenario of I'm wrong. It went down, it went up. It doesn't matter. Like I'm risking 3 to make 2. And it's gotta pop over one of those edges for me to get there.
Yeah.
Right?
If you do the math quick, once again, the back of the napkin math, it's a $5 wide spread that we're collecting $2. We're collecting 40% of the width of the spread. So that means we have theoretically about a 60% probability of success on this trade. That to me, over and over and over, as opposed to buying the 745 call for 720, which means the stock would have to get to 752.20. That means a move beyond like that probability is what is the delta? 20, 18? So you want a 20% chance of success or 60%? I mean, once again, if we're wrong, we're going to lose $3. But over time, you do these trades over and over, you put that probability.
Is this making sense to everybody? I mean, the thing with learning this is it's kind of like, you're introduced to it, you digest some of it, but you have to go over it a couple times to really kind of visualize what happened. That's the way it is. It's just how you learn.
I got a question.
Yeah.
The iron condor. And this is strategy you're using it if you really don't know which direction the stock is going.
Nobody knows which direction the stock's going. If you do,
You're on a boat in the Mediterranean.
No, I'm not trying to be facetious. Yeah. If I don't have a thesis. Yeah.
Let's say in some inclination that I definitely believe that this stock is going to build.
Yep. Mm-hmm. Yeah, no, don't do it then. You would pick one or the other. Yeah. But if you ask me where a stock's going to be tomorrow, you know what the highest probability is? Tell me where it is today. That's the highest probability of where it's going to be tomorrow is where it is today.
So Dan, what do you want to have happen?
So here's what if I was evaluating this right now, we're 15 minutes to the close. Let's start with the premise that I'm long the stock. I would probably look to sell a call, okay, and just take in that premium, high implied volatility. If I not long the stock, I love Q's idea of selling a put spread. You're defining your risk to the width, of that spread, less the premium that you're taking in. So that's a trade that I might do. That comes down to sizing. A lot of people who are making a long premium directional thing will oversize that position, right?
We want to get this trade in, right?
Okay.
Let's
Race against the clock.
Okay, but show of hand. Who wants to just say we don't know where it's going? Let's go. We don't know where it's going. Then we do the iron condor.
Yeah.
Okay. How many people say we're bullish? How many people say we're bearish on this? Okay, I think the iron condor won this.
Yeah. And this is the important thing. So to answer your question, this is a directionless trade. We want the stock to stay right here.
Yeah, can you pop it in?
Iron condors are like kicking a field goal or bowling. You don't want to go outside the gutters or outside the field goal. You want it to stay right where it's at. And our field goal right now is basically $100 wide. So this trade is really, we're not thinking it's going up or down. We just think the market is overpricing the move. And we're selling that.
We just did.
We're short the iron condor.
Okay. Yeah.
So,
This is not investment.
We're going to find out.
So here's your homework. Look at earnings today for Netflix. And tomorrow morning, if we're between our short strikes remind me of our short strikes. See, Robinhood Legend does this first. Can you scroll down a little bit and see the whole chain, Nick?
Yeah. Right here?
Yeah. So you can see
we're short the 640 and the 740. That's where you got to be. So you can't go to 638, past 638. You can't go past 742. That's where you don't want to. That's all you care about.
But it's in between those, and you still get premium.
Oh yeah, you keep that premium if you're in decide to. One other thing. So like the delta, which we talked to you about the delta. That tells you the probability that we land there, right? That we end up there. But there's another thing you can do with delta. Basically, and this isn't exact, but if my delta of landing somewhere is 50, so I have a 50% probability of landing somewhere, double it, and that's a probability we touch that price. That's a good thing if I'm long a call, right? Because I could conceivably like sell out of it. It's a bad thing if I'm short it because then I might get freaked out and cover it, right? Are you following me? So it doesn't, like, being at the price at expiration is different than getting there because it has to stay there. Am I making sense?
These are all the little tricks the floor traders figured out. They would be on the floor. I don't know how the hell you guys did this, by the way. You're on the floor and people are screaming at you 8 hours a day, and you're sitting there with cards and you don't have all this technology. And they're like, yeah, I'm short 2,000 deltas. I'm short this. Let me head shear. Like, so a lot of this is like breathing for a guy like you, and I assume, Dan, you as well. And that's when you know you've graduated from sort of guessing to, I use this analogy. I love analogies. Like when Neo sees the Matrix in the movie The Matrix, the first time he sees it, it's just a bunch of on the screen. But then at the end of the movie, he sees it everywhere, and now he's doing all this crazy stuff. And you get to that point and you can see this option chain and pick out deltas, probabilities, see the expected move, select a strike, know a strategy. That's when you've graduated.
And we've got just about a minute left. All right, we'll stick one more question in.
Do we have net deltas?
Not yet.
Well, we go to the booth after this. We can ask the
It's a good question, because you want to know overall what your delta is. Yeah. We probably want to beta weight it too. So you know what it is overall against whatever instrument.
This trade should be delta neutral because we're pretty much equidistant. It doesn't look like there's much of a skew. So 30, where's our delta on that? Yes, there's a little bit of a call skew here, but long story short, we're probably neutral.
And I know that you're going to walk out with at least a dozen new analogies to rattle off, but I want you to have one lesson as well. And Dan, maybe you can help close us out. If there's one piece of advice or takeaway to options traders trying to get to the next step in their journey.
I think what Q said is the most important thing. He grew up as a market maker. He was selling the options to all the folks, and he probably had a much higher probability of success on almost every trade that he did relative to the folks that were buying him. Is that fair to say? Yep. So again, like rather than buying a call or a call spread, that's how we started talking about it, you're bullish. I love it how he went immediately into selling a put spread. And I think that getting those muscles, trained in that capacity, because a lot of folks just want to buy, unless you are really disciplined, unless you are really good on directional and momentum. It's a hard way to make money over time. And I would just think about layering it on to some of the equity strategies that you have that you're using on individual names and thinking about how best to add yield to this position, not always looking to try to add leverage to it, because usually, as far out of the money, that was a great example of looking at that call spread. The probability of success wasn't great. Keep testing those sorts of strategies. And I think you'll find selling call spreads, selling put spreads is probably the highest probability of success.
Discipline and practice. Thank you so much to all of you. Dan, Q, Obi, and Nick, appreciate the time here, and I hope you all enjoyed.